Since becoming a financial planner, I've noticed that most investors make the general assumption that all stocks are risky and all bonds are safe. Some investors learn about the various asset categories available within the equity allocation, diversifying across large, mid, small, growth, value, developed and emerging markets, and so on. They understand they can buy stock funds in dozens of flavors, yet they assume all bonds are the same, usually with the exclusive role of capital preservation, purchased specifically to not lose money. But since the year 2020, the rise of interest rates and subsequent fall of bond prices has been an uncomfortable wake-up call, with many investors, especially retirees, upset that their bonds did not act as expected. So what happened to stability with those bonds? This lesson is focused on the different types and various benefits of bonds, which may or may not provide one or more of the following: stability, income, and diversification. Stability is what many investors assume bonds provide for their investment portfolio, with a barbell approach between risky equity and safe fixed income. Here is a chart that shows how various types of bond funds performed during the harsh market volatility in February and March of 2020, when the initial fear of the COVID crisis led many investors to flee for safety. The first thing we notice is this 35% drop of the total US stock market index, just within 1 month. Retirees would have expected to log into their investment accounts on March 23rd to see their stock values fallen sharply, but relieved to see their bond funds holding steady. But that wasn't the case for all bonds. Moving up the chart, we see the purple line, which we may have initially assumed to be another type of stock fund since it also fell sharply, but it was actually a high-yield corporate bond fund, dropping nearly 20% that month. These corporate bonds with lower credit quality provide higher income since we'd expect to be compensated for that higher default risk, but they don't provide much stability. High-yield bond returns have been over 70% positively correlated with the US stock market over the past 20 years. When I was going through my CFP education, I remember learning the phrase, "BB guns can hurt you," to remember when investment-grade bond ratings end and high-yield junk bonds begin. When the stock market falls, we can generally expect corporate bonds to follow, but not as sharply. The high-yield bond fund fell about half as hard as the stock market in this example, and intermediate-term investment-grade corporate bonds about half of that. As we move up the chart towards stability, we notice that two things change. Bond credit quality is improved, and bond terms, maturities, are shortened. Bonds can have maturities from a few months to 30-plus years. The chart's top 3 lines showed the greatest sense of stability during the COVID crash, and what some call crisis alpha. This light blue line represents the total US bond market index, which holds a combination of short, intermediate, and long-term investment-grade corporate bonds, securitized bonds, and government bonds. It provides a little bit of everything in terms of stability, income, and diversification, but it doesn't do one thing particularly well. During moments of downward market volatility, US Treasuries have historically exhibited little to even negative correlation to equities, since these government bonds are considered quote-unquote risk-free in terms of default risk. The demand and therefore the price of them increases when investors flee to safety. By giving every dollar a job and a use-by date, you can align your investment's risk and return expectations with when you expect to spend the money. For example, when funds are needed within a short time period, whether to support next year's living expenses, prepare a down payment for a new home within the next few years, or provide an emergency fund cushion, I prioritize stability and liquidity over growth and income. For income needs expected over intermediate periods, such as 4 to 10 years, some investors buy intermediate-term, investment-grade corporate bond funds or treasury bond funds within their fixed income allocation, again matching the bond's duration with their anticipated income need timeline. And for long-term needs exceeding 10 years, I am personally comfortable increasing the equity position. Your own portfolio should be aligned with your unique risk capacity, which is your situation's objective ability to withstand volatility, and risk tolerance, your subjective preferences. When there's a significant gap between risk tolerance and risk capacity, personalized education and guidance can help. Anxiety can be defined as the fear of future uncertainty, so I encourage you to continue learning about investing, including what's in and out of your control. Try to sort through the noise to align what you've learned with your comprehensive financial situation and desired outcomes, not influenced by others' preferences. Please do not act upon financial advice from others who do not understand your quantitative and qualitative variables, including me. I'm just an educator, but not your advisor. Moving back to the three potential benefits of bonds, after stability is income. Naturally, we'd accept higher levels of risk for higher yield, at least with an upward sloping yield curve. I have included a link to the current bond rates below. We generally expect to receive higher interest payments when we expose our money to default risk with lower credit quality, call risk with the possibility of future decreasing interest rates, and inflation rate risk, owning bonds with longer maturities. When retail investors and investment advisors chase yield with the absence of stability or diversification within their portfolio's fixed income allocation, I question the deeper motivations and wonder if a higher equity allocation and less risky fixed income position could be a more appropriate solution. And finally, diversification means owning investments within a portfolio that go in different directions at different speeds. Diversification aims to achieve an optimal balance between risk and return, and not to chase returns while disregarding the portfolio's ultimate purpose to support your desired lifestyle. A lack of diversification is like a baseball game where every player is standing on first base with a baseball bat in their hands. It's important that we own different things doing different things. By the way, this is an AI-generated image for that prompt. I found it funny that that guy's holding a baseball bat and a glove at the same time. I guess we call that diversified. This asset correlation chart shows us the historical positive correlation between corporate bonds and the stock market over the last 20 years, and the opposite with treasury bills, notes, and bonds. When bonds are included as part of a total portfolio's asset allocation, it's important not to analyze them only in isolation. Due to differences in their correlations, an intentional mix may increase the expected risk-adjusted returns. You can use a free tool at portfoliovisualizer.com to compare these historical correlations and visualize diversification across custom portfolios. I've shared a link below. Lastly, keep in mind that bonds can be purchased in different ways depending on which risk you seek to avoid. You can buy them individually or within bond mutual funds or ETFs, as constant maturity funds from ultra short term to long term, or with fixed maturity dates, meaning you can hold your bonds to maturity and have them redeem when you expect to spend the money. This is called asset liability matching to avoid interest rate risk. And to add even more options, you can buy treasury, corporate, or municipal bonds. With this lesson as an educational starting point, I hope you continue to learn more about asset allocation in general and which bonds are best for your situation. I cannot finish this lesson without thanking Frank Vasquez, an amazing investment expert and personal finance educator who has a great bond series, which I've linked below. Thank you, Frank.